Assalamu alaikum. Have a good day. Welcome to Financial Management eLearning. Today, I'm going to discuss Strategic Management Accounting Module 3. So, let's start. So, today, we will learn Modified Internal Rate of Return, Profitability Index, and Post-Investment Audit. So the modified internal rate of return assume the positive cash flow are reinvested at the firm's cost of capital and that the initial outlay are financed at the firm's financing cost. That means every year's cash flow will reinvest. So modified internal rate of return, shortly refers to MIRR, is the internal rate of return of an investment that is modified to account for the difference between reinvestment rate and investment return. So, under MIRR, all cash outflow are assumed to be reinvested at the firm's cost of capital or hurdle rate, which makes it more realistic. So it is the main difference between IRR and MIRR. So if you saw here, in the decision, a project with MIRR greater, the project hurdle rate should be accepted. So per formulas, we can send different way. Look here, is easy. MIR equal to future value, positive cash flow, divided by present value, negative cash flow, that means initial outlay, 1 by n, and here is the number of period minus 1. So FB is the future value, PV is the present value. Also, we can say that terminal value of the cash inflow divided by present value of cash outflow, root to the power n minus 1. So here is, we can give some example. Future value, terminal value, we have to find out terminal value. Future value of the net cash inflow from investment assumed to be reinvested at the rate of cash cost of capital or a specific reinvestment rate where relevant over the investment period. For example, a 3 years investment has cash inflow 1 lakh each year. Cost of capital is 10%. So look here, first year's 1 lakh cash inflow would be, that means first year investment invested for 2 years because 3-year projects. So here 1 lakh comes 1,21,000. In the second year, here 10% is our cost of capital. So 1.1, that means 110% of 1 lakh equal to 1 lakh 10%. That means second year's inflow reinvested for 1 year. But in the third year, inflow cannot be reinvested. So as it is, so total terminal value 3,31,000. I have taken it from this side. And present value of the net cash outflow incurred during the investment period discounted at the cost of capital. For example, a project requires an initial investment for 1 lakh and shall incur net cash outflow 50 lakh annually. in the year first and second, on accounts of trading loss, cost of capital is 10%. So solution, a 1 lakh divided by 1, that means initial investment 1 lakh, 50,000 divided by 1.1, this is last year, 45, and 50,000, 1.8, that means terminal value 186,777. So here, advantage of MIRR, it is better and improved method for project evaluation. It takes into the consideration all the possible reinvestment rate, and it has some disadvantages. It asks for 2 additional decisions, that is determination of financing rate and cost of capital. Managers in the real life may hesitate in involving the 2 additional estimates. So here, one example here, if there is considering an investment 2,50,000 in a startup, the cost of capital of the investment is 13%. Following cash flow in 0 year, that initially stage, 2,50,000 have to invest, and first year, second year, third year will get that amount, that is cash inflow. Calculate the MIR. So here look, we have to calculate in different steps. Step 1, first we have to calculate the terminal value of the inflow, as like this way. So we calculate here 5 years, that means in the first year 50,000, look, this is 50,000 inflow, this is the inflow, and this inflow can be reinvested for 2 years, 13%. So it's come terminal value 63,845. And second year inflow, that is 1 lakh. It can be invested only for 1 year, so we'll get 1,13,000. And third year 22 lakh, third year 2 lakhs, we can't invest it in the 0 year, so total. So total terminal value 376,845. And calculate the present value outflow is terminal, that means 2,50,000. So within this formula, if we put here, then we'll get 14.66%. So interpretation is that the investment should be accepted by FIR because the cost of capital 13% is lower than the MIR 14%. The cost of capital would need to increase by more than 12% before the investment becomes financially unviable. Look here, the calculation. So one thing we can say, what we say, if project return is greater than company cost of finance, that should be accepted in the PI. That means a 1 plus. So it's okay. And also MIR has superior to the regular IRR in 2 ways. It may assume the project cash flow are reinvested at the cost of capital. And the problems of multiples does not exist in MIRR. So MIR, now profitability index. Look, profitability index is an investment appraisal techniques calculated by the dividing the present value of future cash flow of a project by the initial investment required for the project. So it is very much easy. So profitability index, look here, the formula, present value of future cash flow divided by initial investment required, or 1 plus net present value divided by initial investment required. So PI, we can calculate different way. Look, based on given instruction, PI, present value cash inflow, present value cash outflow. So decision would be accepted a project if the profitability index is greater than 1. Okay, so this is the main thing. So example here, a company, FIR, is undertaking a project, cost 50 million, which is expected to generate a future net cash inflow with a present value of 65 million. You have to calculate the profitability index. So look here, profitability index is equal to present value of future cash inflow divided by initial investment required. So here we get 65 million divided by 50 million, 1.3. The net present value, PV of net future cash minus initial investment required, 15 million. The information about NPV and initial investment can be used to calculate profitability index. Okay, so profitability index 1 plus net present value. Here we find net present value is 15 million. So here put 15 million. Okay, then initial investment required, look here, 50 million. So here 50 million. So profitability index is 1.3. So here, look, the calculation is here and calculation is here, is the same. So profitability index accept a project if the profitability index is greater than 1. I think it is clear and you know it. So here some model, this payback period in the decision, record investment before the set period. So here that means value of money, the time value of money ignored. So discounted payback period, time value of money not ignored but accepted. And NPV is most widely used capital budgeting. IRR also used, modified and profit index also used. So now post-investment audit. A post-audit involves checking whether the expected results are truly realized. So immediately after an investment project may be approved and implemented, a post-audit need to be conducted. Most business now undertake post-compliance audit as a routine is a part of the investment process. So post-implementation audit, that means project objective attained, completed on time to a scope, within budget, customer expectation met, business investment achieved, methodology meets project needs. This is the flow of post-implementation audit. Also is the post-investment audit. So it's required because also if you go for financing from the banks, then the project completion report they must need, because for further sanction or further disburse need the project's completion report. Okay, so here one question, NPV and payback period analysis. Suppose that if it has approved the opportunity 25,000 in business, the business plan, home base and fund, lease delivery, terms of the proposal would be received 5,000 at the end of each year, with the full 25 will be paid end of the 10 years period. So assuming 10% of rate of return, calculate the 10% rate of return, calculate the present value of cash inflow. cash inflow at the net present value and the proposed investment. So if you come here, 5,000, 25,000 initial year, first years, and the 0 year is your cash outflow, that investment, and 10 years you will get every year 5,000. So your 10% is cost required rate of return is the base 10% factor. So here present value of cash flow, get present value benefit, that present value and cash cost. So net present value is 5,723. Okay, very much simple, easy. You do not need to hesitate anything. It's very much easy. And then number 2, based on this same interest rate, calculate the cumulative cash flow. So cumulative cash flow, look, just you add it, add this way, cumulative. Okay. Then what is the payback period in the both nominal and present value terms? So here we have calculated the present value there based on the information provided part 2. This clear the cumulative cash flow nominal dollar is 0 is 5 years. So payback period 5 years. But it considers the time value of money, then its calm is to look here. That means this year, in this year 8. So the present value of payback period would be 8.28 years. So okay. So here's some problems, but we're ignoring it. We will learn it later on. Now another is a good question for you. It's a nice question. Look here. Here is a question, a model question, a nice question, I think. The following probability estimated have prepared for a proposed project, FIR. Initial outflow in the 0 year, probability 1, 8 lakh. Revenue year 1 to 5, that's the probability is this way. And when probability is 0.15, the revenue, expecting revenue year 8 in first year, in the second year, third year, fifth year. Same to operating cost, 1 to 5 years, the probability is 0.4, 0.2, and 1.4. We know all the summation of all probability must be 1. So if you sum it, it must be 1. So is the figure. So another thing, MMS Limited, another big company, is currently financed 10 lakh, 7% bond, and 20 lakh of common stock. The stock has beta 1.5, risk-free rate 4%. One thing, when we come, we know the beta or risk-free, that we have to use CIPFA method. I think you all know it. The market risk premium 3.5%. The tax rate 35%. Cost of capital is more than 2.32 of Limited's cost of capital. If where's cost of, look here, is the turning point. If where's cost of capital is more than 2.32%, 32 of MMS Limited. So you have to find out the cost of capital of MMS Limited, and within this that cost of capital, we have to add 2.23 for finding the cost of capital of FOL Limited. And another nice thing is here, expected 3 tax. This tax revenue take 1 to 3, 35, 22, 68. operating cost, tag number 70 tag within the 50 and 90. Calculate the expected net present value using the above tag number. So it is the main charming point of this math, with the tag number as well as probability and others companies cost of capital, etc. So come, okay sir. So here, first of all, it should be not, because revenue, look here, revenue 8 lakh, 10 lakh, 11 lakh, 12 lakh, and probability 0.15424, etc. So if we put this here, this revenue probability, cumulative probability, look, 0.15 plus 0.4 is come here, plus 25 equal to 1. So this probability within the range of, that means 15, here 0, 15 and 0.55, that means 15 to, here based on probability for 15 up to 54, 55 to 79, 80 to 99. So look, tag 1, 2, 3 based on the revenue, which tag they use. Tag 1, revenue 35, 22, 68. So look here, the critical way, 35 within this range, 22, 35 is tag 1, 22 also within this room, so tag 2, and 3, that was 68, look. So 68 within this range, okay? So this is the tag 3. So we calculate the tag. Now, same way, we have to calculate the operating cost. So if we calculate everything, we think that, look here, 70, 52, 90. So 70, 52, 90, here 70 within this range. So tag 1 for operational activities, 52 within this range, it is tag 2, and 90 within this range, tag 3. So I think tax thing is okay. Now, note 3, ration of debt of equity capital, 10 lakh, that 1/3, and a stock 2/3. So cost of equity, that means 9.25. This cost of equity for MMH. Clear? And cost of debt, 445. So weighted average cost of capital of MMH is 768. But we have to calculate the FYR's cost of capital. It's come 10%, because 768 and more than 2.32. Can you remember? Look here, more than 2.32 of MMS Limited. So that is the more than, that means 10% cost of capital for FYR. Now note 4. Tag 1, we have collected from tag 1 revenue, 2 revenue, and 3 revenue. Take the same way, operating expense, operating cost, 1, 2, 3. So here, initial 8 lakh revenue and 10% DCF revenue 10 lakh, 1 to 5 years, because tag 1, look, tag 1 revenue 10 lakh, click here. I also tag 2, 10 lakh, tag 3 is 11 lakh revenue. So revenue 10 lakh, outlay tag 1 8 lakh, tag 1 revenue cash inflow, sorry, outlets there. So inflow revenue 10 lakh, operating cost 7 lakh, tag 1, this 7 lakh, okay, this 7 lakh. So DCF 10% and multiply this, we get the present value of tag 1 is 3,37,300. Same way tag 2, we received net present value 16,400. And in the tag 3, here net present value 17,700. So expected NBV for 3 tags 17,70,800. And if we make it as average, we'll get 5,90,267. So it is an average expected in PV. Therefore, the project is viable since it has a positive expected NBV. So I think it's a good math for you, nice math. And here's so many calculation and thinking. So I think today I am finishing this module, and we will meet you again with my strategic management accounting with my next module. We'll see you soon. So today we have covered mostly in MIRR, Profitability Index, post-investment audit, and we solved 2 problems, and one is most important problems for you. So thank you today, and take care. We'll meet soon. Allah Hafiz.